All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Sam Lau.
Hey, hey.
It's 10:05 Pacific time here on August 23rd. It seems like it was a very, very quiet week this week, Sam. Couple things, as we pointed out last week, that we wanted to keep an eye on, but seems like it was not too much going on.
Yeah, I mean, it seems like everyone was just waiting for the news that would come out today with the when Powell spoke at Jackson Hole earlier this morning. So outside of that, it just seems, I agree, just pretty much a quiet week.
All right,
People just
well,
trying to get a sense of direction.
yeah, and then see kind of what whether Powell is going to hint at something or not. And spoiler alert, he didn't really. So why don't we get into the where are we for the week, and then we'll follow through with the macro and Fed speak.
Yeah, sounds good. So it's a pretty good week so far for the S&P 500. It's up almost a point on a week-to-date basis. Year-to-date, just shy of 19%. So all in all, a good 2024 for the S&P 500 when you take a look at it through those two windows of time. The two bookends of performance within the sectors on the week-to-date basis. Once again, real estate leading the way, up over 3% so far on the week. It's up pretty much. It's the best performer on the week. Looking here, it's the best performer on the month-to-date basis, and it's the best performer on the quarter-to-date basis as well. So, real estate really liking what they're pricing in for, what the market's pricing in for, what expectations are for Fed rate policy here. So looking at on the other end, we've got energy down about 10 basis points on the week to date basis. It's also the worst performer on the month to date basis and second to worst performer after technology for the quarter to date. But all in all, year to date, it's pretty much matching what real estate on the other side is doing for the year to date basis. That's also up 9 points, just under 10% on the year to date basis. But everything else, the other 10 sectors, all in the green for the week to date basis for the S&P 500. Looking across over to fixed income, looks like we had a rally across the board. The 2-year note yield looks like it's about 3.9% right now, 3.93 for a little bit more precision. That's 12 basis points lower in yield than where it closed last Friday, just with a four and some change handle on the yield there last Friday. The 10-year note is 7 basis points lower in yield, looking at 3.82% right now. Don't think, if memory serves, I don't think it closed below that kind of that resistance point that we talked about last week, Jeff, at that 380. So it's just kind of bounced off that line on the close a few times there. And right now we're seeing it kind of test again at 382. We'll see what the
Yeah,
rest of the day holds.
I see a close at 3.802, so I'll give you that.
That's right. So we'll take it for now and see how next week where next week takes us. But rounding out the curve here with the bond, the 30-year bond is at 4 basis points lower in yield, looking at a yield right now of 4.10 for the week. So what that all means for the broader bond complex there with the Bloomberg U.S. bond aggregate, that's up about half a point week to date. Quarter to date, very strong looking here. It's up over 4%. So that's about almost two. It's about 1.5 basis points higher than the quarter to date performance of the S&P 500 right there. So a very strong quarter and second half to date for the U.S. aggregate there. All in all, for the year to date right now, it's just at about 3.5% positive. Looking at it on the year-to-date basis, just for completeness here, we've got a clean sweep of all positive sectors for the fixed income market. Pretty much the leading the way here is EM sovereign debt. We've got high yield in a close second at 6.3% with that positive performance there. And then on the other end of the spectrum, the laggard, if you will, is the U.S. Treasury market up just over 3% on the year-to-date basis there. So similar to what we're seeing with the S&P 500, a pretty strong year. We'll definitely take it after some of these past 2 years of of excitement in the fixed income market, if you will, for the performance there. So
Yeah, I
uh,
see, year to date, quarter to date, month to date, week to date, all the sectors that we look at, all green.
yeah,
I
just a
can't remember
clean
the last time
sweep.
that's happened. Yeah.
Absolutely. Absolutely. So wave that in, as we like to say here on the desk, for that type of performance. It's not that the S&P 500 is that shabby. You do have some reds, pockets of red across various sectors during those windows, but it's also a clean sweep of positive performance year to date for the S&P 500, clean sweep across all markets. Same can't be said for the commodity market, but commodity market on the broader basket of as represented by the Bloomberg Commodity Index is still positive right now, up 1.25%. Week to date, it's up 90 basis points. Intraday, I was looking at all that week to date. Positive performance came on today. Basically, the commodities market, much like the other markets, seem to like the idea or like what Powell had to say today. So that's up about 1.25 when I was looking at earlier on just the on the day for the BCom. So we'll see if it can continue to hold on to this positive performance through year end. It's looking pretty cuspy though at this point, but one big drag on the recent performance within the commodity complex is the energy sector. As we take a look at WTI crude oil futures, the front month futures down almost 2.5%. Right now, I see a spot price or a price on that front month future of $74.88 a barrel of WTI crude oil. That's just about $3 higher than where it ended 2023. So it's been a little bit of a roller coaster ride here for WTI crude oil. Definitely struggling given some of the, if you think about it, relevant to the backdrop that we have in the geopolitical risk surrounding the Middle East there. But one might expect it to be a little bit higher. But there is that question of demand for oil that's dragging on the other end of the seesaw there. Gold here looks like right now at this point it's $1 short of the 2,500 mark. Pretty much flat on the week at 24.99 ounce of a troy ounce of front month futures of gold right now, but that's up 21%, just shy of 21% on the year to date basis. So with that roundup of this week ending August 23rd, Jeff, do you want to kick us off on what happened on the macro front?
Yeah, I did think, Sam, it was also funny that because the gold bar is 4,000 troy ounces, that a gold bar is worth $1 million.
That's right. That's the
It,
first
it
time
seems
in
like it should
history.
be worth more than that. Like if you think of a gold bar in your mind, $1 million kind of seems cheap. Not that it's it's not a great performing asset, as we like to say.
Yeah, it's not a great producing asset, in
Oh,
that type of sense.
yeah,
But
yeah,
I mean, I think you just got your eyes on the gold bars in your mind in Fort Knox, right? Or the
that's right.
pursuit.
Yeah,
Yeah.
$1 million doesn't seem like enough for that weight.
Yeah.
All right, let's get in the macro side of things. On Monday, we did get the leading index that came out at a negative 0.6. It was expected to be a negative zero point 0.4, so kind of revised downward there. That brought the 12-month number to a negative 5.2, and the 6-month annualized number declined to a negative 4.2, which is just above the Conference Board's kind of new benchmark for a recession of a negative 4.4. Interestingly, there was kind of two big positive contributors to the LEI, and that was credit and stock prices. Everything else was negative. Your manufacturing, your building permits, ISM new orders, and consumer expectations. So that was kind of it for Monday and Tuesday. Wednesday, we did get the BLS preliminary annual payrolls benchmark revision. Interesting thing there, was supposed to come out at 7 a.m. on the nose here on Pacific time, and it didn't come out until it wasn't updated on their website until 7:30, and it was a negative 818,000 revision, so a pretty negative for the overall job market. But more people are talking about how that number didn't get updated, and some certain Wall Street firms actually got the number from calling the BLS earlier than it was posted on the website. So it seems like there were some sort of technical issues, and the people answering the phone didn't actually realize it wasn't available. Though, if it was available, you would wonder why people were calling as opposed to refreshing the website. So, a little bit of a disconnect there, and from the BLS standpoint, not a great thing for a very quiet week when everyone was kind of looking forward to or looking to see what this number would be. Luckily for them, it kind of came right in the middle of expectations, and so it didn't really move markets very much. We also got the FOMC meeting minutes later on Wednesday. The kind of the big surprise there was there were some members of the FOMC that were calling for a rate cut in July. Obviously, that didn't happen, and no one voted for a rate cut. So it was just kind of preliminary discussions. But that kind of set the stage for more Fed rate cuts here on the September 18th meeting. Thursday, we got jobless claims. Initial claims came in at 232,000, right on the survey. Last week was 227,000, so a slight increase there. Continuing claims came in at 1.863 million, slightly below expectations of 1.87, but right in line there with the prior month. So not too much there from the jobless claims, nothing to worry ourselves about. We also got the S&P Global PMIs. These are the August preliminary numbers. The services number came in at 55.2, was expected to be 54, so services continue to be strong there. But the manufacturing continues to be weak, came in at 48.0, was expected to be 49.5. So we'll see whether the isms kind of confirm that, but that's the August preliminary numbers from the S&P Global. And then this morning, since it is a kind of a light day, we did get new home sales came out much stronger than expectations at 739,000. That's up 10% month over month in July versus June. And that's it for the week in terms of macro. Everyone was obviously waiting for Jay Powell from this morning. You had a couple people come out, a couple Fed members come out before Jay spoke this morning, and basically Susan Collins said that it would be appropriate for the Fed to begin gradually easing to preserve a still healthy labor market. And Patrick Harker from Philadelphia Fed said that the process of moving rates down should begin in September and be done methodically. So kind of the same thing there. So let's cut over to Powell this morning. Just a little over 3 hours ago now. He obviously releases the text of his speech beforehand, so you kind of read it before he actually says it. But a couple of takeaways I saw that they are talking about, wanting to restore balance between supply and demand with easing inflationary pressures and ensuring that inflation expectations remain well anchored. That inflation is much closer to their objective, with prices having risen 2.5% over the past 12 months. And that progress towards their 2% objective has resumed. And Powell did say his confidence has grown that inflation is on a sustainable path back to 2%. So from that, you can kind of say, okay, rate cuts are coming. Also, they talked about the unemployment rate and how it has risen to 4.3%. And Powell says it's still low by historical standards, but almost a full percentage point above its level from early 2023. And most of that increase has come over the past 6 months. But he does say that so far rising unemployment has not been the result of elevated layoffs, as is typically the case in a recession, or I guess he says economic downturn, not a recession. But the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. And so it's not really a case of the unemployment rate rising because of layoffs. It's just more people entering the workforce, which is something we've been talking about over the past couple of months, Sam. And then finally, he kind of says, the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. And so really, we're going to have to wait and see what the non-farm payroll number comes in as, to see whether the Fed is going to move at 25 basis points in September or 50 basis points. Right now, we're looking at a 35% chance of a 50 basis point cut. And so the remainder, there's a 100% chance of a 25 basis point cut on September 18th. We're back up to 4 cuts this year and 9 cuts up from 8 between now and the end of 2025. I guess people were saying that the biggest, the most important phrase that Powell said was, we do not seek or welcome further cooling in labor market conditions. So now it's really just a point of, as long as unemployment doesn't rise too much from the 4.3 level, that really they're going to just continue with their slow pace of cuts. If we do get a rise, then you would expect them to cut rates much faster.
Yeah, I mean, I think I would agree with a number of the points that you made too early on. It's just there's nothing really new that was said, right? But he did confirmation of things that he had said in the past pressers, but he definitely delivered a lot more panache than
Yep.
as pressers. He came out this he's used the word confidence, he exuded confidence, and you almost think that he took a victory lap, in terms of some of the things that they've accomplished thus far. He was making jokes about the good ship transitory, and how it was a crowded ship early in the early days back in 2021 going to 2022. Um, he also just basically said that I think there's a comment there where he's talking about how a lot of people doubted that inflation could be brought back down to the sustainable path or that's target of 2% without a recession, or the sharp rise in unemployment. And he just says, it's we're kind of showing that you're able to. So we'll
Yeah,
see. We'll see how things
and
go.
the rest of his speech was kind of just like instead of outlook, which is obviously what we're looking, most important at this point in time, was kind of a history lesson on why things were that where inflation was high, what the kind of the thought process was, and it's not as interesting since we lived it. I don't really feel like we need to go back and revisit it at least from here. Let's look at going forward.
Yeah, and I was listening to it. I had it on the YouTube, but I wasn't really watching. I was doing other things, and based on the applause that I heard after this this little mini speech here, I had to click on for the visual to see if people were actually giving him a standing applause. That's how loud, enthusiastic it was. So definitely the economists there at the forum or symposium, I suppose, really did enjoy what he had to say. And as we said before, it seems like the markets are kind of liking what he had to say. As I look at it now, the S&P 500 opened up higher relative to yesterday, but and it did spike a little bit higher relative to when he first started his speech. But as of right now, it looks like the S&P 500 is kind of flattish to slightly up, ever so slightly up from where it started on the day. So we'll see. It's been kind of a choppy ride thus far intraday, but so far the market's seeming to like what they heard.
Yeah, generally, yeah, I would agree with that.
You know,
If we kind of move on to next week, the things to keep an eye on here, we got durable goods on Monday. That's expected to be 4.2. X transportation expected to be flat. We got the house price indices on Tuesday. The 20 city month over month expected to be a 0.3%. It was a 0.34 last month, so not much of a change there. We do get GDP on the 29th. What day is that? That's Thursday, I believe. Um, that's expected to be
correct.
2.8%. And we get the kind of inflation numbers with that. Obviously, jobless claims again on Thursday. And then on Friday, we get the PCE, what Powell cares about. Core PCE month over month expected to be 0.2. That would bring the year over year number to 2.7. So kind of actually up from 2.6 last month. So we'll be interesting to see what happens there. But also the headline PCE expected to be a 2.6 up from 2.5 last month. So a little bit of a spike in terms of inflation, but I think Powell has pretty much written that off as as long as it's not getting too out of hand, not really worried about that. And then we get the University of Michigan 5 to 10 year inflation expectations also on Friday. It was a 3% last month, so unless that pops up, nothing to worry about there either. So should be a pretty quiet week to end the month of August there.
Yeah. So we just have a few more data prints of each series, or sorry, one more data print of each one of the kind of important series that come out between now and September 18th with the next FOMC meeting. So the PCE, we've got one CPI print and the jobs data. So just a couple of key points to keep an eye out for the next few weeks, and we'll see if there's any change in direction, I suppose, with that. But
That's right. And
things will be
Sam,
interesting.
don't forget, last week is or next week is the last week you can wear white before Labor Day.
Yep.
And
Yep.
with that, I guess that wraps it up. I'd like to thank everyone for listening.
Yeah, thanks everyone for tuning into the minutes here. Um, don't forget you can check us out on the X at DLine Minutes or send us an email if you have any questions, comments, or suggestions.
Yeah, our website is doubleline.com. YouTube channel is youtube.com/doubleline capital. We do have our this podcast up there. So those of you that tuned in late, you can hop on and catch the replay on there. Obviously, you can find it on your podcast platforms also. I guess that's it. Nothing else and nothing new on the YouTubes with the quiet week. So thanks for tuning in and hope everyone has a great weekend.
Yeah, everyone enjoy the last week of August here. Thanks and good luck out there.